How the wealthy reduce inheritance tax legally. The real playbook. Most people think inheritance tax is a punishment for success. You work hard, you build wealth, you take risk, and then you pay 40% at the end. But that framing is misleading. Inheritance tax is not a rich person tax anymore, and it's not primarily a success tax. It's a procrastination tax. Inheritance tax is charged at 40% on the value of an estate above the allowable allowances. And with those allowances frozen, more ordinary wealthy families are drifting into exposure without realising it. The Office for Budget Responsibility forecasts inheritance tax receipts reaching around £8.7 billion in 2025-2026. HMRC data shows receipts rising year after year. This is no longer a niche planning area for billionaires. It's a mainstream issue for property-owning families, business owners, and long-term investors. The uncomfortable truth? Most families who overpay didn't do anything reckless. They just started too late. They assumed their will solved it. They assumed they had time. They assumed they would deal with it one day. Inheritance tax is fundamentally time-based. The wealthy don't look for loopholes. They build systems, and they start early. Before we talk about structures, we need to anchor the basics. Every individual has a nil-rate band of £325,000. For married couples or civil partners, they can transfer unused allowances between them. So that's typically £650,000 per couple. There's also the Residential Nil-Rate Band, £175,000 per person, available if you leave a qualifying main resident to direct descendants such as children or grandchildren. In a clean scenario, £325,000 plus £175,000 equals £500,000 each. For a couple, £1 million, potentially passed on before inheritance tax. But there's a technical catch. The residential nil-rate band tapers down once an estate exceeds £2 million. It reduces by £1 for every £2 over that threshold. So larger estates can lose that additional allowance entirely. This is where planning starts to matter, because once you drift above £2 million, tax exposure can increase sharply and quietly. If I could give you one inheritance tax planning tool, it would not be a trust. It would not be a company. It would be time. Most effective inheritance tax strategies operate over 7-year periods. Many lifetime gifts are known as potentially exempt transfers, or PETs. You can gift up to £325,000 every 7 years. If you survive the 7 years from the date of the gift, it falls outside of your estate for inheritance tax purposes. Die within 7 years and the gift can be dragged back in. There's a taper relief if death occurs after 3 years. But here's what sophisticated families understand. This isn't about one 7-year window. It's about stacking them. 7 years, 14, 21, 28 years. Time compounds decisions. Let's use clean numbers. If someone strategically uses the £325,000 nil-rate band every 7 years, often via structured gifting or trust planning, then after 21 years of gifting, that's £975,000 shifted outside of your estate. And for a couple, that's £975,000 times 2, so £1.95 million removed. If that would otherwise have been taxed at 40%, that's £780,000 of inheritance tax potentially avoided. That's not aggressive planning. That's time and structure and consistency. And notice something important. Nothing dramatic happened. No panic. No last-minute manoeuvres. Just disciplined, repeated action. The wealthy also use the unglamorous rules, because stacked over time, they matter. £3,000 annual exemption per person per tax year. You can also carry forward one if it's unused. £250 small gifts per person per year, with technical limits on mixing exemptions. And the most important one is gifts out of surplus income, potentially unlimited if they're from income, they're regular, they don't reduce your standard of living, and they are properly documented. Now consider this. If a couple can genuinely gift £2,000 per month from surplus income and record it correctly, that's £24,000 per year, £240,000 over 10 years, potentially outside of the estate immediately with no 7-year clock if it qualifies. Again, boring, consistent, powerful. The biggest barrier to planning isn't tax, it's fear. What if I give too much away? What if I need it? So structured planning flips that order. Step 1, secure your lifestyle. Step 2, secure long-term care modelling. Step 3, plan your legacy. You gift surplus wealth, not essential capital. When planning starts in your 50s or early 60s, longevity risk can be modelled properly. Fear shrinks when the numbers are understood. Confidence grows when lifestyle is protected first. Trusts are often misunderstood. A trust separates legal ownership from benefit. It can move assets outside of your estate whilst maintaining control and structure. But trusts have their own tax regime, including how much you can put into trust every 7 years, as well as periodic and exit charges when capital leaves the trust. It's important to seek out advice here. Trusts are not set and forget. They're powerful for bloodline protection, divorce risk mitigation, creditor protection, vulnerable beneficiaries, and also remarriage scenarios. But timing matters. Trusts created early feel strategic. Trusts created late often feel rushed. Another structure increasingly used is a family investment company, or a FIC for short. Think of it as a corporate investment wrapper. Parents often retain voting shares, growth shares are allocated to children or trusts, future growth accrues outside of the estate over time. You separate control from value, but again, patience. These structures work best when established early, invested prudently, and professionally managed. They are frameworks, not shortcuts. For business owners, the rules are changing. Business property relief has historically allowed qualifying business assets to pass free of inheritance tax. But reforms from April 2026 changed the landscape. The first £2.5 million receives 100% relief. Amounts above that receive 50% relief. And at 40% inheritance tax rate, that means an effective 20% inheritance tax on the excess. For a qualifying business with assets worth £4 million, it's a tax bill of £300,000 attributed to the excess. But also remember, BPR generally requires 2 years ownership. For business owners, planning now needs work both before and after 2026. This is definitely not a wait and see situation. Most inheritance tax plans fail in 2 places: poor documentation and poor alignment. Gift letters missing, bank trails unclear, no evidence of surplus income gifting, and then wills say one thing, pensions say another, shareholder agreements conflict, LPAs aren't aligned. Wealthy families treat the estate as one ecosystem. A clear gifting policy, a clear will and beneficiary strategy, appropriate vehicles, and one spreadsheet the family understands. Clarity beats cleverness. Inheritance tax is not primarily a technical challenge. It's a timing decision. The families who reduce it the most effectively start early, plan across multiple 7-year cycles, use structures thoughtfully, protect lifestyle first, document everything, and stay consistent. 7 years matters. 14 years matters more. 21 years is where families create meaningful outcomes, like moving 1.95 million outside of the estate and potentially reducing tax by £780,000. Nothing theatrical, nothing aggressive, just long-term, disciplined action. So don't ask, what's the best inheritance tax strategy? Ask, when should I start? Because the most powerful planning move you can make is beginning before it feels urgent.